Investing in dividend stocks is an excellent strategy for building passive income. My strategy for investing in dividend stocks is to look for companies that have excellent potential to increase the dividend per share over an extended time. I'm thinking 10 years, 20 years, etc. And that might be very different from dividend investors focusing on stocks with a higher dividend yield. There's one dividend stock in particular that I feel has a high probability of increasing its dividend per share over the next several decades. Furthermore, this dividend stock is selling at a reasonable valuation when measuring by the forward price to earnings ratio. It also generates excellent profit margins with top-line revenue growth in the double digits. And it has one of the strongest competitive advantages I've witnessed in any company worldwide. So let me share with you what is this dividend stock I'm discussing and the reasons why I have it rated as my top dividend stock to buy right now.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, the dividend stock I'm talking about is Visa. Visa is the stock I'm talking about here. Visa, one of the main reasons why I like Visa stock is because it has 4.5 billion cards outstanding, and that's up by 300 million from the same time last year. So not only did they already have 4 billion cards outstanding in people's wallets on people's phones, but they also added an incremental 300 million year over year. That phenomenal customer adoption is what makes Visa so attractive, because merchants, businesses, they are forced essentially to accept Visa cards at their establishments, because if they don't, they're missing out on over 4 billion purchasing power customers that may or may not spend money with you if you don't accept Visa. So this competitive advantage is one of the best I've seen. And not only that, if you look at Visa's dividend per share, $2.01 over the trailing 12 months. If you compare that with the earnings per share over the trailing 12 months of $9.35, you can see that big difference between earnings per share and dividend per share. That means Visa has lots of room to continue increasing its dividend per share, even if the earnings per share remains flat, which, as you can see, far from the case, right? In the last decade, Visa's earnings per share has increased from $2.50 to $9.35. And it's reasonable to assume that its earnings per share will continue increasing over the next several decades, because as people spend more money with their Visa cards, Visa's revenue increases. And you might say, well, how are they going to drive revenue growth? Two forms. Number one, by adding more Visa cards. And secondly, by increasing the average revenue per card. And that's partly going to happen just because of economic growth. Visa takes a percentage of every transaction that happens using a Visa card. And so just by economic growth or just by inflation, the percentage increase in spending on Visa cards will increase. And then if Visa gains market share, that will only add incrementally to its revenue growth. Speaking of revenue growth, over the last 10 years, Visa has averaged 11% annual revenue growth. That's really strong revenue growth for a company at its size, at its scale, with its history. And to make this even more attractive is Visa generated 67% operating profit margin in the most recent trailing 12 months. This is one of the highest operating profit margins I've seen in any business. It's even higher than it was 10 years ago, where it was at around 64%. They've increased that to 67%. 10 years ago, if you were to show me its operating profit margin at 64%, and you would have asked me, is this going to go up or down over the next 10 years? I would have said it's going to go down, because it's hard to sustain an operating profit margin this high for this long. But Visa is demonstrating that it can continue to do that because of that strong competitive advantage, because of how many billion Visa cards are in people's wallets and the pricing power that commands. And it's an asset-light business model. The company just needs to maintain that network, maintain that platform, invest in the technology, the back end, the plumbing services that makes everything work. and it can keep generating this level of profit margins. Now, its competitive advantage is so strong that governments are claiming that it's too strong, that, they need to be less powerful. And that's always a good sign, right? You've seen me recommend a lot of companies like that have competitive advantages that are so strong that the governments are questioning them. Alphabet is another one. It's under scrutiny by governments for having a competitive advantage that's too strong. And so you can tell I'm attracted to these kinds of companies that have such commanding places in the marketplace, that the governments are trying to do something about it because other business competitors haven't been able to encroach on their businesses. Visa's return on equity at 48.33% is phenomenal, and that's up from 20% 10 years ago, more than doubled where it was. Return on equity, if you remember from accounting, equity is assets minus liabilities equals equity. And return on equity is how much profit you generate from the equity in the business. This shows how powerful the assets are in the business. How much profit can you generate from the assets you have, from the assets you've built inside the business? And Visa is generating remarkably strong return on equity, and that return on equity continues increasing because it doesn't need to reinvest in assets into the business at a very large scale. A small percentage of its profits does the company need to reinvest into the business. And finally, I highlighted that it's selling at a reasonable valuation. Visa is trading at a forward price to earnings of 25.96, which is not cheap, but it's also not expensive. It's trading at a fair value. And I would prefer paying a fair price for an excellent business any day. And that's what I feel like I'm getting with Visa. I do own Visa stock, by the way, full disclosure. I do own Visa stock. I have owned Visa stock for a couple of years now. And these are the reasons why I like Visa stock, why I own Visa stock. All of these reasons I mentioned in this video. Double-digit revenue growth, close to 70% operating profit margins, a nearly unstoppable competitive advantage that governments are trying to break up, and you're getting this company at a fair value. Forward price to earnings of 26 is a very fair price to pay for Visa. So I know what you're going to say. Visa's dividend yield is really, really tiny. It's much smaller than you can get with many other dividend stocks. And so that makes some dividend stock investors, shy away from Visa as a dividend stock. But I remind you, when you're investing in dividend stocks, as long as you're not in a position to need that dividend income right now, if you're building for your retirement or if you're trying to build passive income over the long term, Visa can do that for you. It has great profit. Its earnings per share compared to dividend per share is favorable. And so it can continue increasing the dividend per share over time. And 10 years from now, 20 years from now, this stock can increase its dividend per share, maybe double or maybe triple where it is today at $2 per share. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.